Seems like everybody in Australia has an opinion on whether the Australian property market is going to boom or bust. And right now, a lot of that opinion seems to be talking about an imminent collapse in Australian property prices. I remember seeing something on the other night where some guy jumped online and said, or jumped on national TV and said that property prices were going to drop by 40%. The next day he's kind of reneged about what he said and said the likelihood of that happening is about a 20% chance. How he pulled that out of the air, I'm not sure, and I'd love to see that data. But what I'm going to try and do in this video is talk about some of the obviously negative things going on with the Australian economy, Australian property marketplace right now, as well as some of the positive things as well, and just look at it like a pros and cons list. Right now, Australian sentiment seems to look a little bit like this. It's either boom, which we've just been through in Sydney and Melbourne for the last 5, 6, 7 years, or it's bust. Now, for most Australians that don't understand anything about investing, about finances, because we've got to remember that 80% of Aussies will end up from my generation on the pension. So most people don't have the financial acumen to have a meaningful conversation about where they'll be in a week's time financially, let alone where they're going to be in 5, 10, 15 years financially. And you've got to be aware of that, and just across that, you know what I mean? Like, take my opinions with a grain of salt. Take everybody's stuff that you're listening to with a grain of salt. Now, obviously everybody has an agenda or an approach to looking at different things based on their worldview. Your job's just to take all of those different opinions and make a decision for yourself, whatever that really looks like for you. So let's talk about some of the negative stuff, or the bust thing. Now, this bust story has been going on in Australia now for about the last 18 to 24 months. If you're inside the industry, you would have started to notice this as a property person or as an economist or whoever else that's, you know, really following this stuff day to day. That sentiment started to shift about 2016 when the second round of changes by the Australian government came into play in terms of limiting the amount of loans that they were going to write. And what you can see right now is the result of a controlled effort by the banks as well as the Australian government to put a stop to the speculation occurring in Sydney and Melbourne so that our whole world didn't collapse. So let's talk about 11 different reasons why, you know, the Australian economy slash Australian property market might not be in the best position right now. And then we'll talk about, you know, the other side of the equation, because to the average punter, it's either boom and bust. You're either in or you're out, where, you know, sophisticated investors understand it's a completely different approach to that. It's about being strategic. It's about taking advantage of both boom and bust conditions. I personally am more of a bear of an investor. I like the bust conditions. I like markets right now where a lot of people that don't really know stuff are sitting on the sidelines, as opposed to when everybody else is just jumping in, because it's really hard when everybody's in the market to find deals. Where right now, and I think over the next 18 to 24 months, there'll be definitely some good deals on the table. So first thing that I hear a lot about at the moment, which is very, very clear to see in the data from Heron Todd Wyatt, from CoreLogic, from Residex, from John Lindemann, is that Sydney and Melbourne, let's just call them, they're cooked. The easy money's gone. In fact, those markets have completely topped out and now they're starting to decline. For anybody that follows the CoreLogic updates from Tim Lawless over there, and CoreLogic's by far the leading property analyst in Australia, and it's where all of the journalists get or manipulate their data from. You know, did an article since last week which he sent out and looked at all of the times that property prices have busted in Australia since 1983. I think in Sydney there were 9 times where property prices had declined somewhere between 3 and 11%, with a total decline over that period of time of about 50% if you added all of those losses up together. And then if you looked at the Melbourne, I think there were like 5, maybe 6 times in Melbourne where property prices had dropped between 1% and 11% as well. So it's completely normal for property prices to go down, but Sydney and Melbourne are cooked right now. I wouldn't be investing in those markets. I've been talking about that on videos now for 2.5 years. You can go back and check out any of my stuff, either here or on the On Property channel, and really just get an idea of how easy it is to see this stuff coming. I sold all of my property in Sydney and the Central Coast in 2016, early 17, and sold out at the top. You know, smart investors understand and see those things coming, or put properties into positions where, okay, things might drop for a period of time between 1 and 3 years. That's completely normal. It's part of a cycle, you know, but the media doesn't talk about it that way. So, you know, unfortunately, that's not what's getting sold on the Today Show right now. What's being sold is headlines and scare stuff, which is completely cool. I'm happy that prices have dropped in Sydney and Melbourne, as brutal as that sounds, because they were scaring me in terms of how expensive they were. And, you know, again, you could see it coming. Now, the second thing going on right now is that Sydney and Melbourne are at the top and declining. Sydney and Melbourne right now, one of the things that is concerning people is that prices are declining. Prices are going down, and that scares people because they don't know how long that's going to last for or how far they're going to go down. Now, what people don't know about Australia is that all sorts of things have happened over the last 200 years around property. Now, in the 1890s, property prices in Australia dropped by 90% after the gold rush. Property prices have dropped by 90% once in Australia. Now, it hasn't happened for a long time like that, and hopefully that doesn't ever happen again. Otherwise, you know, almost every Australian is going to be wiped out financially, and the country would struggle to bounce back from something like that. But the likelihood of that happening with our banking system these days is extremely unlikely. In fact, you know, I don't know what a percentage would look like for that. It'd be cool if someone could analyze that. But property prices do drop, especially after they've gone up by somewhere between 60 and 80% over a 5 to 6 year period in Sydney and Melbourne. What happens in a property market is that prices generally go like this after the last recession, then they go up, then they top out and can either sit flat, can go down, or, you know, any one of those two things, you know, and then they do that again. It kind of looks like a wave long term, and it's just something to acknowledge as an investor. Right now, the Sydney-Melbourne markets are in this phase where prices are coming down. How far they'll go down is dependent on how far they went up. Now, if you bought 5 or 6 years ago and you've made 80%, if prices go down by 20% from where they are today, then you're still in a great position. What's challenging is if you bought in 16, 17, 18 in Sydney and Melbourne, and property prices are, you know, over that period went up by 20%, but have now, you know, gone down by 5 or might go down by 15%, you know, you're sort of caught out. And as Warren Buffett says, when the tide goes down, you get to see who was swimming naked type thing. It's a brutal way of looking at things, but the market is unforgiving, and it can hurt some people based on when they buy and not understanding this sort of stuff. Now, the third thing I wanted to talk about is a high household debt. Now, Australians have a very high household debt in relation to our incomes. I've heard people have different opinions on this. A couple of Australia's economists say that the way that we calculate household debt in Australia is skewed compared to the way that other countries do, because we count investment properties in the way that we look at the average household debt per resident in Australia, where other countries don't look at investment properties as part of that pool. Australians are also, from a debt perspective, very, very leveraged in property. So we've had this fascination in Australia of investing in property for about the last 30 to 50 years, and that has resulted in, obviously, if Ben Everingham's carrying $1 million worth of debt, it looks like I have very, very high household debt, but it's debt against an asset or a property type. Now, I've got other friends that are much more conservative, that don't invest in property, but that do shares and crypto, and, you know, they believe that high household debt only works if there's somebody else, as they call it, to catch the extra hot potato. So I'm throwing this property to you, someone else is picking it up and buying it, and leverage and debt only work while that system continues to work. And as soon as the rug is pulled out from that system, property prices can slide like anything else in the marketplace. Now, we saw this in 2007 to sort of 2011 in America, where some states like Texas, you know, there was no impact of a GFC from a property price perspective. Other areas, you know, dropped in value by 10%, and some areas dropped by as much as 30 to 50%. So it is market by market dependent, depending on how leveraged people in that area are at that particular stage of the cycle. The fourth thing that is negative, I suppose, from a bust perspective about Australia right now is we have very low interest rates. Now, that's concerning for a number of reasons. One, debt is very, very cheap and easy to service right now. When we went into the last GFC, the Reserve Bank of Australia had a much higher cash rate, and obviously banks were passing on those interest rates at a much higher rate as well. And one of the things that got us out of the GFC outside of the resources boom was the fact that they could drop those interest rates to kick the economy into gear again and get people moving through things. But we don't really have that option if we're going to go through another hard time, because interest rates are already very, very low, particularly from the Reserve Bank of Australia level. There is an option to go lower. We know that rates in Japan, in some parts of America, as well as some parts of Europe, were set at 0% for much of the last 7 years after the last GFC. But you know, that's just called pumping or priming an economy. It's a false way to get things ticking away again. So that's something that I'll watch out for as well. You know, a fifth thing is that we've got an election coming up. People like to sit on their hands while elections come up. So the fact that there's an election coming up with prices already dropping in Sydney and Melbourne, and then if you overlay this concept of negative gearing, or potentially taking out or changing some stuff in relation to negative gearing, maybe changing some stuff in relation to capital gains tax or stamp duty, this election is going to be an important one to watch for investors. Now, whatever your opinion on it is, all of these things at a macro level, big picture level, do have an effect. One of the core things that it looks like they're going to be talking about, I saw ScoMo today talking about this and yesterday, is immigration. Now, immigration has been the lifeblood of Australian property. The fact that we've got the fastest immigration or fastest population growth rate out of any developed country in the world, we look more like a developing country in terms of our population growth rates as opposed to a first world country, which we are. So anything that they do around immigration, in terms of the number of people that they're letting into Australia, is going to have a long-term effect on property prices. Now, what they're proposing is that they stop letting people move into Sydney and Melbourne and potentially move them into other areas like Southeast Queensland, other states, other regional markets and metro markets in Australia for the first 5 years. And it's not everybody, it's just people without a connection to someone in Sydney or Melbourne. So, you know, it's interesting to keep watching that one. I love it as someone that, you know, is completely past the Sydney and Melbourne thing at this stage in the current cycle, and who's really been looking at Southeast Queensland with interest for the last 3 years. I really like the fact that we could capture a higher percentage share of those immigrants, because right now more Australians are moving into Southeast Queensland than any other place in Australia. If the immigrants move there as well, we all know what population pressures do on economies, as well as local markets, and therefore supply and demand around property. Something that I've heard a lot of people talking about is this switch. So I'll just do that as in a switch from interest only loans to principal and interest loans. Now, a bunch of people that set up interest only loans 3-5 years ago will be getting very, very close over the next couple of years to switching those loans up. Now, I think that some of those people would have liked to have gone interest only again, but the banks at the moment are going to want a lot of those people to go principal and interest. So that's going to have an effect on pricing of or people's affordability to hold certain properties, and it might mean that properties, particularly with people that are over leveraged in Sydney or Melbourne, might come onto the marketplace because of affordability. So again, another one to have a look at. But again, if you bought a property 4 or 5 years ago You might have paid in Sydney or Melbourne at that time 700K. Now the property's worth $1.1 million. You've got a fair equity buffer there as well, and as long as you're strategic and you keep a consistent tenant, a lot of those people will be able to move through that as well. The eighth thing that I wanted to discuss from a bust perspective or a negative perspective about the Australian economy at the moment is China slowing down. So, you know, we're very, very reliant on China from a trade perspective now. And as their economy slows, even though, again, they completely, you know, apparently cook their books as well to make it look like they're moving in a direction, and it's very difficult to get accurate information out of China. You know, China's production rates are slowing at the moment, their consumption rates. So it's just interesting to keep an eye on what's happening over there as well from a big perspective. The ninth thing, and I think probably the most important thing, and the reason I can guarantee you'd be watching this video and why I'm recording it, is fear. Now, all of these things are fear. In any economy, in any world, there are an infinite number of possibilities that could happen. There's the possibility in one universe or one world that property prices could drop by 90% in Australia or America or Europe. There's another possibility that property prices could drop by 50%, 30%, 10%. Who knows? I don't know. Nobody has a crystal ball and can accurately predict the future. And I'm going to talk about that more on the boom perspective, just in terms of how you can start to understand this cycle in a much, much, much deeper way, based on looking at history and people that have really understood this stuff in the past. And there's a couple of people that have called the booms and busts of the past years before they've occurred, and you can learn from those people to understand where we are right now and where we will be in the future as well. So fear is huge. It is infectious, and it is getting passed through the Australian marketplace with your average mums and dads in a big way right now, because, you know, the biggest shows in Australia are smashing it, the biggest papers are smashing it. Now, you've just got to have a look at that and think about that for a moment. You know, when was the last time you listened to a mainstream media outlet where they didn't show you somebody dying that day? And if they've got to show you somebody dying just to get your attention from a story perspective to sell their advertising, then what sells in property? There's two things that sell in property, and that is a boom, which we've been talking about and they talked about for 3 to 5 years before right now, or a bust, which is the death of the Australian property market. So that is selling really good right now. It's getting their ad revenue up, but these are people that talk for a living about people dying, about the most horrendous stuff, the car crashes, the stabbings, the shootings in Australia, and they love a good story to sell. So I take my news objectively. I look at the people that analyze the marketplaces, the economists, the data providers, as opposed to the mainstream media where, you know, a young journalist or a mature journalist is, you know, just reporting on whatever's going to sell the most advertising space. Now, I'm not saying that Australian property in any way, particularly in Sydney, Melbourne, isn't overpriced right now, and I believe will continue to correct for a period of time before it stabilizes again. But, you know, come on, like, let's get real about this stuff and about who is producing this data and, you know, what the agenda is behind people that are doing it. So the 10th thing that I wanted to talk about is, again, around people. Now, people right now can't differentiate between what's happening in Sydney and Melbourne with the rest of Australia. They just have no concept of being able to see past what's immediately going on in the headlines. And I'm talking about the average punter here, you know, that is just getting everything from 1 or 2 news sources that are promoting one particular worldview, and that worldview is infectious and holds that community of people together. Now, people can't differentiate that Sydney and Melbourne have gone up by, you know, let's call it 50 to 85% in the last 7 years and are really fucking expensive right now, versus, you know, Brisbane that has absolutely done nothing in the last 10 years. In fact, it's gone up by less than 1% per annum, although the average income of a person per household in Brisbane is now higher than the average household of a person in Melbourne. So, you know, property prices are over 100% more expensive in Sydney than Brisbane. They're, I think, something like 50 to 60% more expensive in Melbourne than Brisbane. Those markets have gone through their cycle. You've missed the boat. Let's see how far they decline. That's completely cool. But over time, people will still look at what can I do with my money? And the story around Southeast Queensland from a population, jobs, income perspective is starting to look a little bit brighter each day. And at some point, the attention will turn, and it's not when, you know, prices have moved by 30% up here that you really want to be looking at it. It's when people have been sitting on the fence for a long period of time and are doing nothing for no particular reason, and that's something that I'll talk about in a minute. Now, I know that's going to ruffle some feathers of some of you watching this, and I don't mean to put anyone off because I don't have an agenda or an opinion around this stuff in any way. These are just sharing some of my observations about the bust market and soon to be some of the conditions that create a boom market and the things that I like about Australia. So, you know, it is what it is, and these are just some thoughts. The 11th and last thing that I wanted to talk about here is the Royal Commission. Now, the first results of the Royal Commission were released recently, and when the Royal Commission was originally proposed, you saw the bank stocks in Australia drop quite dramatically. Now that partial news has come out on the Royal Commission, those stocks have started to increase in value again. Now, what I love about the stock market is it generally prices in bad news a lot faster than property does, because, you know, stocks and shares are more liquid, where property is a little bit harder to sell quickly at a fire sale without a loss. So the Royal Commission has been something that's going on. We're obviously finding out that there's so many people in the Australian property industry that are just filled with absolute shit, and these people at banks have been writing dodgy loans. Now, what we don't know right now is just how deep the issues with the bank's balance book or the books. What we don't know from the Royal Commission yet is how bad the bank's books actually look and how over leveraged they are in relation to property, and what effect a drop in property prices in Australia would actually have on their books. But we'll hopefully soon find that out. Now, that's one of the reasons why property prices were so cooked in the last GFC, because banks and countries all over the world had so much speculation around property, and the banks were so over leveraged to it, and they thought that the cycle would never end, that, you know, when people started calling in loans, when things went from interest only to principal and interest, when rates increased globally and money was harder to get, and that hot potato stopped being passed around, we had some issues. Now, I'm really intrigued to see what comes out of the Royal Commission. I've been following it very, very closely, obviously, and you know, it seems like there were some dodgy loans written by some dodgy people. We're yet to see what the impact of that's going to be on the sector. But what I love about this is, you know, for anyone inside the industry, you've been seeing this now for 2.5 years. It was 2.5 years ago, 2 years ago, when APRA originally stepped in and started to go, enough's enough, we've got to slow this thing down. And they started to look at loans differently. They want principal and interest, they want bigger deposits, they wanted more responsible lending, and now it's just flowing through to actual property prices. So we've got to remember that all of this bust conditions has been created by the Australian government. Yes, it's the time in the cycle after Sydney and Melbourne have had such a strong run for them to recorrect. You know, will that recorrection be 5%, which it is right now, or will it be 25%? That's yet to be seen. You know, and we will go through that, and, you know, the cool thing about 3 years from now is we'll know all of this, and we'll be able to look back at this and go, it was this, or it was that, or it was this bad, or it wasn't as bad as we thought it would be. They're the sorts of things that are, you know, coming up in the media at the moment. They're the sorts of things that are on investors' minds, I think. You know, I'm sure there's some things that I'm missing there, which, you know, people can comment on below. everybody's got an opinion and an approach on this at the moment, which I completely understand. You know, these are the reasons why people are calling a bust in the Australian property market. What's interesting is that one of the rating agencies globally just took Australia, Sydney and Melbourne off the off the bust list, I suppose. There's a list of countries and markets around the world where there's a likelihood of a property bubble or a property bust. And then they've just put it down to highly expensive now, or highly overexposed. So, you know, we've been taken off the bubble list and we put on the very expensive list, or highly, like, ridiculously expensive list. But I think, you know, what's interesting is that outside of Australia, other countries around the world are now looking at what the Australian government has stepped in and done through APRA as a way to cool down their marketplaces as well. So, you know, while the news in Australia is doom and gloom and bust right now, people are looking at that as best practice to cool their own markets off as well, because markets don't exponentially go up forever at 15% a year like they have been in Sydney and Melbourne. And anyone that thinks that is just absolutely idiotic and crazy. What I look for personally as an investor is a good time to buy, which is generally when other people aren't. And I'm not trying to break world records when I buy myself. I would be very, very happy if I could get a 4.8% return from a capital growth perspective on my properties over the next 15 years, which means anything I buy today over that 15-year period increases in value, you know, or doubles in value over that period of time. Now, I don't want to break records. I understand that over the next 15 years, there's going to be good times and really bad times. Some years I might lose 20%, some years might do nothing, other years I might make 20%, but that's the game we're in. And, you know, that leads me on to the boom market. So we've talked about the bust and all the negative stuff, and everybody in Australia knows this right now because all that's happening is it's being rammed down people's throats. But let's talk about some of the positive things that are going on in Australia right now that people seem to have forgotten about. Now, the first thing that I like to look at when I'm thinking about the future is the past. Now, Australian property prices are never going to double every 7 to 10 years. I don't believe again, but you know, I'm sure people didn't think that prices in Sydney would double 10 years ago to where they are today either. So I think if you've got this model that property prices just go up forever, that there's only good times in property, that you know, property's going to double every 7 to 10 years, you know, go check out someone else's stuff, because that's not me. Like I said, I'm more of a bearish style investor. But history shows us that if you buy high quality, well located houses on big blocks of land in Sydney, Melbourne and Brisbane, then long term you can do very, very well from property. Maybe not as well as your parents did, as your grandparents did, where property prices literally went up by, you know, 11% per year over the last 100 years. But if we look at the last 10 years in Sydney and Melbourne, you know, 7-8% per annum. If we look at the last 30 years in Brisbane, 6% per annum, 8% in Sydney and Melbourne. If we look at the last 50 years, an average of 9.5% in all of those markets. So, you know, great gains have still been made, even though they weren't supposed to be made. And the same things have been said in the late 80s, 90s, 2000s, early 2000s, after the GFC. You know, there's always a boom or a bust about to occur at any moment in time, and you know, right now the bust is selling the advertising space. So understand your history is the number one thing you can do. Now, when we talk about cycles, there's a couple of dudes or guys, I'm sorry, that have really figured it out based on history. Now, Fred Harrison is my most interesting economist that I follow personally. He's a guy based out of the UK. Now, he wrote a book called The Power in the Land that in 1983 or 1984 was published, calling a recession in 1990, which was a huge recession which, you know, wiped out property prices and stock prices around the world. Now, in 1983 or 1984, he called what would happen in 1990. He then wrote another book which he published in 2005 called Boom Bust, where he predicted the 2007 GFC in 2005. You know, so this guy's got a pretty good track record over a 30-year period of time of sort of seeing what's coming before most other people do. So if you haven't read his book, The Power and the Land and Boom Bust, I highly recommend them, because it's not like we can predict the future, but we can remember what's happened in the past. Now, Fred Harrison says that this period that we're going through at the moment is very close to what's called a mid-cycle slowdown, where property prices in the major cities around the world that have done really well outside of the last recession or depression, like the GFC, start to either sit flat or decline a little bit in value. Now, that has been happening, according to his research, for over 300 years in Europe. And then, you know, what happens after this mid-cycle slowdown, according to his research, is that property prices come back again in a very, very strong way, and then they top out, and then we go into the next recession or depression, which is much, much bigger. And he's calling that around about 2026 is his timing for the next global GFC that is really going to knock people out in a big way. So whether what he believes or what he's publicized comes true or not is yet to be determined, but he's been saying that in videos now online for quite a period of time, and he's obviously got a 30-year track record of calling these things well in advance. So you know, what he says is that the biggest boom of all time is yet to come globally, and I know a lot of you watching this are going to really struggle to hear that, but if you can't hear that from me, I think you should look at his stuff as well as Phil Anderson's stuff. Now, Phil Anderson also wrote a book called The Secret Life of Real Estate and Banking. Phil also predicted in 2005 in writing, in magazines, in the publications that were listening to him, that we were going into the next recession in 2007. In 2009, he also recalled the first person in the world to record the recovery. When people thought that this would never turn around again, he was calling it. Now, again, very, very similar timelines, but different research. He looked at 250 years worth of property prices and share market booms and busts in America. And again, he calls about 2026 as the top of this cycle. Now, I know some of you will be sitting there going, Ben, property prices in Sydney and Melbourne cannot go any higher, and they should go down by 40%. And that's cool, you know, that's your opinion. I personally don't have one. I'm just an investor trying to make the most of market conditions. But Phil and Fred Harrison have very, very strong opinions and are very public in their opinion of what's going to happen. Check out their stuff if you sort of want to get a much, much deeper approach to what I just talked about, which is history. Now, another thing that I wanted to touch on, which I think is a good thing for Australia. Now, it might not mean much for property prices while they're sliding down in Sydney and Melbourne right now, but it will medium to long term. And as investors, take off what's happening this month, this quarter, this year. You can't control that. In fact, you can't control where property prices go ever. And the sooner you acknowledge that as an investor, the better off you'll be. All you can do is learn about the market and take advantage of conditions to set yourself and your family up for life. But let's talk about population growth. Now, in the last 12 months, there were 380,000 new people that added to Australia's population. I think we're at 25 million people now. We've got the fastest population growth rate out of any country in the developed world, and our population growth rates much more aligned to somewhere like a developing country as opposed to the developing world. Now, I'm not saying that's a good thing or a bad thing, but what it means is that there's a lot of extra people coming into this country, and if we look at the future, which I think is the third point, the Australian government is publicly saying that within our lifetime, within my lifetime, there'll be over 60 million people living in Australia, which is almost, 3 times as many people that live here right now. So just think about that for a moment, what Australia would look like with 60 million people living here. Do you think property prices could, over a 30 or a 50-year period, increase if the population is due to increase by that much? The Australian Bureau of Statistics have come out and said that Sydney and Melbourne will be cities with over 10 million people each in them within our lifetime as well. And, it's just an interesting concept to think about, population and extra jobs and extra services and extra consumption and extra households needed for that, and extra infrastructure spending to support that is all part of the future that we are going to be a part of as Australians. Now, whatever your approach is to immigration and population growth, good or bad, it's going to have an effect on property prices, I think, in an overall positive way long term. Now, if we look at the makeup of the Australian property market, what we've got is we've got 30% of people in Australia are always going to need to rent because they're never going to be able to get themselves on the property ladder, and that's just the way that it is. We've got 30% of Australians that own property and are either have paid it off outright or are looking to pay it off, and that's their own home. And then we've got, you know, the investment side of things, which depending on the time of the market is probably 30 to 40% of the makeup of the Australian property market. Now, why this is interesting to me is that, you know, if we're looking at what effect investors actually have on the overall market, with 30% of the people just living in their own home, either paid it off or paying it off, and 30% of people renting, the investment market really only makes up somewhere between historically 20 and worst case scenario 55% of the marketplace. Most of the time it's more somewhere between 30 and 40%. So that's the investment market, the one that's been absolutely hammered at the moment. That's the one that everybody's talking about, which booms and busts. But the reality is it only makes up 30 to 40% of the marketplace, with mums and dads and renters, you know, making up the rest of that marketplace there as well. So it's something important to take into account, which I think is a really positive thing. It's not like we're sitting in a country here where 100% of people just speculate on property all the time. The reality is people need to rent, and people want to buy and live in their own homes and pay them off outright over their lifetime. That's always been part of the Australian dream. It might change in the future, but I highly doubt that. Now, the fifth thing I wanted to touch on or talk about is this concept of government debt. Now, we all know in Australia we have high personal debt and personal household debt, and you know, that's one thing, that's fine. As I said, those numbers could be a little bit skewed because property makes up such a large part of the average Australian's debt. But if we look at the government debt in comparison to almost every other developed country in the world, our government debt is extremely low. And as bad as it sounds, in a good position in relation or in comparison to other countries around the world. Now, I know people are going to have different opinions on this, but you know, that was one thing that enabled us to get through the last GFC. Because we're in a surplus at that time, the government had money up its sleeve and could get itself into debt to pump prime the economy through it. We're not going to have that luxury in the next GFC because we are carrying debt at the moment, but the government's position isn't too bad, and the government, at least while it's a Liberal government, is looking to reduce that deficit and continue to, you know, pay off that debt so that the Australian economy gets into a better position long term. Now, the sixth thing that I wanted to talk about is really around, it's actually affordable in Australia outside of Sydney and Melbourne. Now, Sydney and Melbourne are ridiculously expensive right now. I think, you know, they're up there with the most expensive places in the world to live based on household income. But when you realise that Australia is a market which has more than 2 capital cities, because there's 25 million people living in Australia and only 10 million living in Sydney and Melbourne. So there's this whole other country going on. And we start to look at markets like Southeast Queensland, Brisbane that have sat flat for 10 years, or Perth that's since its high declined in value by 15%, or Darwin since its high declined by 22%, or other places surrounding those big cities. It can actually be very affordable to buy in Australia. Now, that might not be something that everybody watching this wants to hear, but you know, it can actually be very affordable to buy. You just have to take off the Sydney and Melbourne hat and start thinking outside the box, start getting educated about what other options are out there as an investor. Now, as someone that grew up in Sydney that has a strong bias for that city, like everyone in Sydney, you know, you want to see your city doing well. You hate when you see it going backwards, but I've had to re-educate myself on Brisbane, the Sunshine Coast and Gold Coast, and it's taken me a period of 6 years to do that. But now that I have my head around those markets, there is such strong opportunity up here from an affordability perspective and a future potential perspective that it gets me really excited. So we have, sorry, I've gone straight to 8. We do have very strong job growth in Australia right now. There's a lot of jobs being created. You know, the government sort of does this thing where we went from mining to construction, now we're moving into an infrastructure boom. But all of these things, whatever you want to call it at the time, really do create dollars for people now. Australia's unemployment rates are low at the moment. You know, I'd like to see them a little bit lower. Something with a 4 in front of it would be really nice. But, you know, we really come into, based on history, problems when unemployment rates, you know, go 7, 8, 9, 10%, which is where they, you know, generally are. And if you look at the last GFC, where they were in the last GFC. So strong job growth along with low unemployment figures are things that we look at now. We can't control them. At different stages of the cycle, they go up and down, but you know, that's something interesting to keep your eye on. Now, the 8th thing that I wanted to talk about is really strong infrastructure spending and plans for infrastructure. There is huge amounts of infrastructure projects in the pipeline for Sydney, Melbourne, Southeast Queensland that look super exciting, Perth as well. It's about getting your head around those projects and capitalizing on the growth that occurs around those projects as well. But I think that's where, you know, the Australian government's moving us to now in terms of the next thing, in terms of keeping the Australian economy running the way that we do. Now that the construction boom is settling itself down, I think there's going to be a massive wave of infrastructure spending, which is cool. Now, that leads me into the Australian economy as a whole. We do have amazing resources under the ground. We do have a place that people want to visit, which is the tourism dollar. We do have a strong financial services industry, which, you know, comprises of nothing compared to obviously your New Yorks, your Singapores, your Hong Kongs, your Londons, but Sydney and Melbourne do have a strong financial services perspective going on there. And we've also got the construction side of the Australian economy, which is, you know, whether private or public, whether it's development or whether it's infrastructure or mining, there's a strong construction element. Now, none of these things work all of the time. Right now, tourism seems pretty good, financial services seem pretty good, construction and infrastructure seem pretty good. You know, mining apparently is starting to come back a little bit. If you know people inside some of the big companies, you'll know that jobs are definitely being created there at the moment. I'm not sure what that's going to mean, but jobs are a positive thing, particularly in that sector where there's such a strong emphasis on high-paying jobs and skill. So the 10th thing, which I suppose when thinking about the future and where Australia is going long-term, is that understanding the stage of the cycle. Now, I know to a lot of people, you will believe that the Australian property market is about to fall off a cliff and prices are going to drop by 40, 50, 60%. That's okay, but according to your Phil Andersons and your Fred Harrisons that have done the hard work of actually researching 250 years of history, 300, 350 years of history, and that have been accurately predicting this stuff for, you know, in Fred's case, over 30 years, in Phil's case, the last 12 years, the stage of the cycle that we're in right now is more closely aligned to a mid-cycle slowdown as opposed to a completely globally land price-led recession. Now, I got an email from Phil a couple of days ago which said, don't buy the hype, don't allow what's happening in the media right now around the world to give you fear that the cycle won't continue to unfold like it has, because all of the signs are in place for this cycle to continue. That's going to be really hard for some people to hear because you haven't read that stuff yet, or it's just, you know, out of alignment with your worldview, and that's completely fine. Again, this isn't Ben Everingham's opinion. This is just ideas from people that have been calling it for a lot longer than me. Fred Harrison's been accurately predicting it for longer than I've even been alive. So I don't want to try and reinvent the wheel. I just like to take ideas from the smartest people around and share them with the world. So the stage of the cycle right now is more closely aligned to mid-cycle as opposed to top of cycle where we get a GFC style event. You know, these guys are saying to prepare for a bit of a stock market correction over the next possibly 3 years in a pretty big way. Maybe a little bit of a economic slowdown or a recession in parts of Europe, parts of America, potentially even Australia. you know, that will have an effect like it already is in Australia in terms of property prices. But depending on which side of the fence you sit on as an investor, it can also be a really good opportunity to buy some stuff. So the stage of the cycle doesn't really support right now, according to the history and according to Fred and Phil, a full-blown collapse of property prices by 40% in Sydney or Melbourne right now. But it only takes one time for them to be wrong for everything that they've ever thought about to be, you know, completely written off into history. So the last thing that I wanted to talk about is really, I suppose, bigger picture, and it's separated from everything I've talked about so far. There's two things there actually. One is long term. The second one is strategy. Now, I think a huge amount of investors right now are getting caught up in short term. They're thinking about whether their property is going to boom or bust this year, this month, this quarter, in the next 5 years. You know, doom and gloom mentality is very much short term thinking. And if property prices do go down by 40%, then a lot of people are going to be really hurt. It also represents an incredible opportunity as a buyer as well, if that is due to occur, and hopefully you're in a position to capitalize on that, or a good market or a bad marketplace. But the reality is, my approach as an investor who's bought over $300 million worth of property now for myself and my clients is a longer term perspective of the future. Stop getting caught up in today. Take a breath, stop getting caught up in the month, the quarter, the year. Things go up and down, and that's completely outside of your control. But what you can control is learning more, thinking about the negative and the positive, or the positive and the negative. If you're more wired to positive, you need to think about bad. If you're more wired to bad, you also need to remember that there's good stuff going on too. And in any marketplace, the good and the bad are always at play with each other. And your job is to capitalize and take advantage of that. So when I'm thinking long term, I'm thinking, where will I be in 15 to 20 years if I don't do anything? Where will I be in 15 to 20 years if I do something? And even if your timing was absolutely horrible in 1990 and you bought at the top of the cycle just before property prices dropped by 11 or 12% in Sydney, your property price is still 3 or 4 times higher now than it was in 1990 as a result of what's happened since then. So even if you completely stuff up your timing and buy at the very top just before a GFC or a recession we had to have style of event, you can still do very, very well if you've got a longer term picture. And the markets are very, very forgiving over the long term. You can look at the American S&P, the Australian ASX, the European markets. You can look at property prices in any of those areas, and over the long term, prices are very forgiving, particularly in the big cities where you can do very well. So the last thing I want to talk about is strategy. That's a whole nother video in itself, but strategically, there are definitely opportunities right now. There will be more opportunities, I believe, over the next 12 to 24 months for very smart investors to take advantage of sentiment and fear in the market. I personally believe, Ben Everingham, based on everything that I've read, that this correction in Sydney and Melbourne is going to be medium or mild to medium, which might mean a 10%, maybe a 20% correction at absolutely worst, before it flatlines for a period of time, incomes increase again, and it starts to look affordable again. Now, it's not going to look affordable for a while, and anyone that's seen CoreLogic's data in the past, you know, and overlaid the next 5 to 10 years that we're going into, will know what I'm talking about there in terms of Sydney and Melbourne for the next 5 to 10 years should historically underperform compared to places like Brisbane and some of the other markets in Australia. And if you look at your history and you look at the patterns, you'll be able to read that and see that yourself. But I also believe strategically there's some incredible opportunities right now as well. So I've done another video on this 18-year property cycle from Fred Harrison and Phil Anderson if you want to learn more about that. I hope, you know, you can remove yourself from the short-term media hype. You can realize that yes, there are some things going on right now which feel uneasy. Completely normal for Sydney and Melbourne to be going backwards right now. You know, there's also some things that are really positive as well that aren't getting any attention right now, and there's heaps of other things I didn't mention there too. Your job isn't to go out right now and over leverage yourself and put yourself in a position where you can't sleep, but your job as an investor is to take advantage of market conditions. You know, Sydney and Melbourne are done. Cool, let it go for now. Come back to them when they're affordable again at the right time. But places like Southeast Queensland represent really interesting value. So, you know, get your head around them. You know, control your media sources and get a balanced opinion. I read something the other day that since 2011, Facebook and the major news outlets have been modifying the algorithm so that you only see news that is directly aligned to the way that you think. And people are getting their information from less and less sources now. So more and more influencers or people, you know, like on the Today Show, for example, or a Current Affair, that control the conversation of millions of people and the thoughts of millions of people are getting far more reach. And then the other different ideas are being thrown out of the algorithm as we get more and more ingrained in our particular worldview. Now, I don't know whether it's going to boom or whether it's going to bust in the next few years. Frankly, I don't care. I'll take advantage of both market conditions. But what I do know is that over the next 15, 20, 30 years, Australia is going to be in a much better position. Property prices are going to be significantly higher than they are today, as hard for some of you, myself included, sometimes will believe. But, you know, the cycle always has a funny way of making, you know, incomes increase, society's more productive, extra surplus cash, which always from an economic modelling perspective gets tied back into property prices. So any gain in society in terms of wages, any gain in society in terms of technology or innovation always gets pumped straight back into prices of property. And that's been happening around the world for 200, 300 years in America and Europe. You can pretend that it hasn't been, but that's the reality of the economic system. The land captures the rent and the productive value of the economy, and it's always done that, which is why so many people use property that understand it to put themselves in a better financial position. So, hope you've enjoyed this. I don't personally believe that property prices are gonna fall off the side of a cliff or the Australian property market's gonna collapse, but you know, what does Ben Everingham know? Let's see what happens in a couple of years' time when you can review this video back and see how things are actually tracking at that time. So if you haven't already, please subscribe to the channel. I always try and be as objective as I can, where I share my thoughts, you know, the opinions of the boom crowd, the opinions of the bust crowd, and just try and balance out the conversation a bit so that you can sleep a little bit better at night. If you're a current investor, if you're thinking about investing, you've got a more balanced approach to thinking about how to do that. So regardless of where you're at, good luck with it all. I wish you all the best as an investor now and over the next 15 years. Thank you so much for your time and attention today.